Good afternoon. My name is Myron, Frans, Commissioner of Minnesota Management and Budget. I'm joined today with Dr. Laura Kalambokidis, the State Economist, and Britta, the State Budget Director. We are reporting today the projected balance for the next biennium, fiscal years 20 and 21, is now $1.5 billion. There are so many 20s in these years. I'm just going to say 20 and 21 and 22 and 23, but if you get confused, raise your hand and I'll go back. But I just keep saying 2020 all the time. At the beginning, I want to make sure that we talk about the good news that this is for our budget stability in Minnesota, but I also must mention some caution. We'll explain in more detail later in the presentation, but it's important to remember that the the balance for 2021 and 21 and 22 is $1.5 billion, but the balance, projected balance, planning balance for 22 and 23 is $456 million. For those of you who have been here before, you will recall the concept that ongoing spending in one biennium tends to grow a lot in the next biennium. So the idea of one-time spending will be something we'll be talking about. And also, we will talk a little bit later on as well about the fact that some of the budget spending projections do not include inflation, and so inflation is another issue we need to talk about. But I want to be clear that our continued budget stability is great news for Minnesota. The first time that I presented a budget was in February of 2015, and at that time it was over $1 billion, and I wrote in my notes the word smile because I was so nervous. It was my first one. I was nervous I'd forget to smile, but I'm not forgetting today. I'm smiling today because this is really good budget news, budget stability news for this forecast, even though we're going to urge some caution in the future. Today we'll explain the changes that have been made since our last forecast in February. The projected balance of $1.5 billion for fiscal years 20 and 21 has grown because of increasing revenues and decreasing expenditures. Other good news is that we are increasing the budget reserve total today to a new state milestone of a little over $2 billion, $2.075 billion. I will show you that slide in just one moment. For 22 and 23, Dr. Kalambokidis will describe how the economic outlook has weakened since last February with slower revenue growth projected. Budget Director Reitan will describe the reduced spending growth in both the next biennium, 20 and 20, and the biennium after that, 22 and 23. As always, there is risk with any forecast, and we will explain those risks going forward. The cornerstone of budget stability, in our view, is an adequate reserve in the event of an economic downturn. We learned this the hard way. When I started with the Dayton administration in the immediate aftermath of the Great Recession, there was no reserve. We had a $6 billion deficit, and budget gimmicks had borrowed from our students to pay our bills. It is impossible to invest in the future or take care of those suffering the most from an economic downturn when you have no money and you have a huge deficit. Our proudest achievements include restoring our state's financial stability with a strong budget reserve and making investments for the future of Minnesota. We leave this legacy as a bedrock for the next administration and the legislature to further invest in Minnesota. As we examine our budget reserve, please notice that there are two components in the state's total reserve, sometimes collectively called the state's rainy day fund. We have a statutory budget reserve and the cash flow account. The statutory reserve rule requires that any positive balance in the current biennium in the November forecast must allocate 33% of that positive balance to the budget reserve. The current biennium ends on June 30, 2019. Now, we also had some other budget allocations to the budget reserve so that the total addition to the budget reserve in this forecast is $491 million. That brings our total budget reserve to $2.075 billion. The statutory reserve target amount is 5% of non-dedicated general funds. That's $2.25 billion. We are now within $175 million of filling the budget reserve. The total rainy day fund available now is almost $2.5 billion. Our budget policy has been recognized as one of the most sophisticated and smart reserve policies in the country. We are pleased to show constant progress in this over the last 8 years. Budget Director Reitan will now describe the budget outlook and will show how these reserve calculations affect our budget.
Thank you, Commissioner. My name is Britta Reitan. I'm the State Budget Director. This next slide shows the change in the budgetary balance in fiscal years 18 and 19. As you can see in the lower right corner, the overall budgetary balance has increased by $432 million since the end of session estimates, and this is after the allocation of additional funding to the budget reserve. Since the end of session, revenue estimates have increased by $609 million, and expenditure estimates have declined by $306 million. We'll talk more about the drivers of those changes later in the presentation. Even before the statutory allocation of 33% of the balance to the reserve balance increased by $137 million due to two additional statutory allocations. The first is $90 million in remaining funds from the healthcare premium subsidy program canceled to the reserve. And the second is $47 million of excess surplus from the workers' comp assigned risk plan was deposited into the reserve. Moving to the next line, the stadium reserve declined by $8 million relative to our previous forecast. This reduction is due to a decision that given the size of the reserve balance, it's no longer necessary to deposit $20 million in corporate franchise tax revenue into the reserve each year. As you may recall, this was a supplemental revenue source to the stadium reserve, and now that money falls to the bottom line of the general fund. These changes leave us with an estimated balance of $1.074 billion, and 33% of that, which is $354 million, is allocated to the reserve. When you add that $354 million with the $137 million from the line above, it brings the total reserve change to the $491 million that Commissioner Frans mentioned. This leaves $720 million available to balance forward into the next biennium. So this next slide provides the budgetary picture for fiscal years 20 and fiscal year 21. This is where you can see the $1.544 billion that is now projected to be available for the upcoming biennium. A combination of increased revenues and decreased expenditures, as well as an increase in the balance that is rolling forward, drives the increase in this estimated available balance. Revenues have increased by $190 million, and expenditures have declined by $489 million compared to our previous estimates. On this chart, you can once again see the $491 million in the increased reserve balance. And the stadium reserve is once again reduced, this time by $22 million from previous estimates, but it's still growing year over year. And this is once again due to the removal of corporate franchise tax revenue into the reserve calculation. We'll provide further details on the drivers of the expenditure and revenue changes later in the presentation. And now I'll hand it over to Dr. Kalambokidis to talk about the economy.
Great, thank you, Britta and Myron. I'm going to start by talking a bit about the the outlook for the U.S. economy and how that outlook has changed since we last prepared a forecast in November. Then I'll talk about Minnesota's economy and then talk about the revenue forecast details. The first chart compares the current U.S. real GDP forecast by our macroeconomic consulting firm IHS to their prior forecast. So the dark bars on the chart show the history, so some history since the Great Recession, and the November outlook by IHS, and that's the forecast that informs our forecast. The light bars show their February 2018 forecast. So if you just focus for a minute on the years 2017 to 2023 on the right-hand side of the chart, you can see that the outlook for U.S. economic growth, especially next year, especially after next year, has weakened since Minnesota's forecast was last prepared in February. Strong growth in the second and third quarters of this year led IHS to increase their expectations for this year's real GDP growth from 2.7% in the February forecast to 2.9% in November. They maintained their forecast for growth in 2019 and 2020, but their outlook for 2021 through 2023 is weaker than it was in February. And if you look at the current forecast, so the dark bars for 2018 to 2023, so looking at the dark bars on the right side, and how they gradually step down, you can see a slowdown in economic growth through our forecast horizon. While current economic conditions can support moderate growth this year and next, IHS expects the economy to begin slowing in late 2019. This occurs as the fiscal stimulus from the Federal Tax Cuts and Jobs Act fades, monetary policy becomes more restrictive, Global growth weakens, and a strong U.S. dollar relative to our trading partners' currencies pulls down net exports. After mid-2020, a decline in the labor force participation rate due to an aging United States workforce is expected to slow the economy even more. So there's a demographic aspect to this as well. The downshift continues with annual real GDP growth expected to decelerate from 2.9% annually in 2018 to less than half that rate in 2023. The history on this chart, so the bars to the left here, the history, the years since the recession of 08-09, illustrates one of the risks to this forecast. The dotted line is at 3.1%, and it shows the average annual real GDP growth during the 20 years prior to the recession. So that 3.1%, as you can see, is much higher than what we had been getting since the recession and what is in our current forecast. And when the economy is growing slowly, there's not much margin for error. It's harder to recover from a setback than when growth is higher. And the U.S. expansion, as you know, is now the second longest on record. It will be the longest if it extends into the middle of 2019. And as you can see from the IHS forecast, it is indeed they do indeed expect the expansion to continue well past 2019. But a mature or long, low growth expansion like this is particularly vulnerable when negative shocks occur. The next chart compares Minnesota's labor market performance to the nation's. This chart shows the headline unemployment rate. The dark line is for Minnesota and the light line is for the United States. The vertical gray bars show the U.S. recessions, and the white space between the gray bars are the recovery and expansion periods between the recessions. With the U.S. expansion well past 9 years old, Minnesota's steady economic performance and tight labor market continue. Even as available workers are becoming scarce, the state's steady job growth has kept the unemployment rate low. Minnesota's unemployment rate currently stands between the low points of the previous 2 expansion periods at 2.8%. That's nearly 1 percentage point below the U.S., half a percentage point down from last year, the 5th lowest among states and the lowest we've seen in 18 years. The next chart illustrates Minnesota's tight labor market. So that low unemployment is one sign of a tight labor market, and high demand for labor is the other side of that tight market. The gray bars on this chart show, the height of the gray bars shows the number of unemployed workers in Minnesota statewide, and the height of the dark bars shows the number of job vacancies statewide. In the height of the gray bars, you can see the peak of unemployment during the recession, and then you can see how Minnesota's steady job growth has whittled that down as we've drawn people into employment. The dark bars show that job vacancies statewide have grown to a very high level. The ratio of unemployed persons to job vacancies statewide has been less than 1 over the past year. And even prior to that, in 2015 and 2016, where it was close to 1, I was saying this was a tight job market. But now we've gotten to the point where that ratio is less than 1, and now it's down to about 0.7. That means there are fewer unemployed job seekers than open positions across the state. And the tight labor market is being felt all across Minnesota. For the first time in this data series, both the Twin Cities and Greater Minnesota have fewer unemployed persons per job vacancy than job vacancies. The large number of open positions illustrates a strong demand for Minnesota workers and certainly not an unwillingness of Minnesotans to work. In fact, the data show Minnesotans to be very hardworking. The overall labor force participation rate is well above the national level and is the highest among U.S. states. And the flip side of our low unemployment rate is a very high share of the over 16 population, over age 16 population that is working. That's also well above the U.S. rate and is the highest, also the highest among U.S. states. Moving to the revenue forecast. Total general fund revenues for the current biennium are now forecast to be, as you heard from the budget director Reitan, $609 million more than the February forecast. Higher expected individual income, corporate, and other tax revenues more than offset a reduced forecast for sales tax revenue. In addition to the changes in the near-term economic outlook, this forecast reflects new estimates of the revenue impacts from taxpayer responses to the federal tax law changes and the Tax Cuts and Jobs Act. as well as additional sales tax revenue expected to arise from a recent U.S. Supreme Court ruling regarding the state taxation of remote sales. The largest dollar amount change in the current biennium revenue forecast is the individual income tax, which is forecast to generate $419 million more in the current biennium than we had estimated in February. And that's due to higher than expected income tax revenues so far in this biennium. These positive changes offset revenue forecast reduction due to expected taxpayer responses to the federal tax law changes. So this is not a change in Minnesota tax law. This is the Tax Cuts and Jobs Act changed, and people changed their behavior that in ways that might affect their Minnesota taxes. So for instance, individuals choosing to itemize deductions on their Minnesota returns, even though they take the standard deduction for federal purposes. So to restate that, those changes took money out of the individual income tax forecast. Sales tax revenue in FY 18-19 is now forecast to be $120 million less than the February forecast. This change is due to lower than expected gross sales tax receipts so far in this biennium, slightly slower projected growth in spending on taxable goods and services, and higher forecast sales tax refunds for the current fiscal year. But we also added to sales tax revenue for the impact of the U.S. Supreme Court decision in South Dakota v. Wayfair, which allows states to require remote sellers to collect and remit sales tax on sales to customers within the state. The revenue addition, however, was not large enough to offset the negative changes I've already mentioned. The forecast change for the next biennium shows a similar pattern. Higher forecast individual income, corporate, and other tax revenues offset a slightly lower sales tax forecast to raise the revenue forecast for the next biennium by $190 million. And the dynamics are similar in this biennium too. Faster growing individual income offsets a revenue reduction from taxpayer decisions, and in addition to forecast sales tax revenues for taxation of remote sales is not quite large enough to completely offset a lower base of sales tax receipts. The next slide will illustrate one of the taking a longer term view. If you recall the stepwise deceleration of economic growth that we saw in the first slide, you can see that over our planning horizons, growth in total revenues is also declining. Now, through what we're showing, the height of the bars here shows the annualized or per year growth of total revenues from one biennium to the next. And throughout the three biennia that are included in this forecast, revenues continue to grow, but the pace of growth is slowing. So from 16-17 to 18-19, the annual growth was 3.4%. To the next biennium, it falls to 3.2%. By the time we get into the years of our planning estimates, it falls to 2.5%. And Budget Director Reitan will talk about the impact of the revenue slowdown on the state structural balance. So let me conclude by drawing your attention to some of the risks in this forecast. This forecast the U.S. forecast that we used to construct this assumes that all of the U.S. tariffs and other countries' retaliatory measures that were in place or scheduled in early November are in place, are permanent. But as you know, U.S. trade policy, especially regarding China and the revised NAFTA agreement, has been in flux. Prolonged uncertainty imposes costs on businesses in particular that have to address supply chain disruptions, and they may put investment plans on hold, which can slow economic growth. The stock market's solid gains of earlier this year were disrupted by volatility in recent months. In this forecast, IHS expects the stock market to remain volatile, but with continued moderate appreciation in equity values. But if the recent stock market decline worsens, or if the market generally underperforms IHS's expectations, the resulting erosion of household wealth could cause consumer spending to grow more slowly than IHS's forecast. The Federal Tax Cuts and Jobs Act, the federal tax cut of 2017, made some big changes to federal tax law, and individuals and business owners have had to decide how to respond or alter their choices and their behavior responding to that law. But because we haven't yet seen tax returns for 2017 and certainly not for 2018, uncertainty remains about how people actually did respond to those changes and how their choices impact state tax revenues. And finally, with 30 months before the end of the next biennium, we have not seen any of the total revenues that we have forecast for the biennium. Even small changes to assumed growth rates, in particularly volatile sources such as capital gains or corporate profits, could materially alter the budget picture into our planning horizon. So I'll turn it back over to Budget Director Reitan.
So moving to the expenditure side, expenditures are down relative to forecast in both biennia. Starting at the top of the chart, in E12 education, expenditures are virtually unchanged. The change since end of session in both biennia is less than 0.1%. Property tax aids and credits have increased relative to end of session estimates by $11 million in fiscal years 18 and 19, and $64 million in fiscal years 20 and 21. This is largely due to growth in property tax refunds for homeowners. I'm going to skip past the Health and Human Services line for a moment, which is the largest driver of change, because the next slide provides some more detail. So moving down to debt service, estimated spending on debt service is down by $26 million in fiscal year 18 and 19 due to a smaller bond sale than we originally anticipated and improved rates. In 20 and 21, the estimated expenditures increased by $18 million. And the reasons are pretty much the inverse. We expect a larger bond sale next summer than the one we had this summer, and we assume that rates will be increasing. The all other category changes by $74 million in fiscal year 18 and 19. The largest driver of this change is $90 million in lower spending on the healthcare premium subsidy program. And in 20 and 21, the all other line declines by $40 million. $26 million of that reduction is in the area of corrections, and it's due to a lower prison population forecast. So moving back up to the Health and Human Services line, expenditure estimates are down $216 million in fiscal year 18 and 19 relative to end of session. This is due to lower enrollment across programs and additional federal revenue for chemical dependency treatment. In fiscal years 20 and 21, total estimated expenditures declined by $517 million. Approximately $383 million of that, or 75% of the change, is in medical assistance. So the next chart shows the total change in medical assistance in this forecast through the next biennium. The top line displays the end of session estimate for medical assistance, and the bottom line is this forecast. The largest component of change within medical assistance is lower than expected growth in managed care rates. The blue portion of the space between the lines represents the savings due to those managed care rates going forward. The rates for calendar year 2019 grew less than anticipated, and those rates are based on the actual experience in 2017, which was also lower than expected. The reduced growth rates are likely due to the health plan's efforts to lower costs following the competitive bidding for calendar year 2016. There are other changes in medical assistance represented by the dotted section above the blue on the chart, and the biggest drivers of that additional change include lower enrollment in medical assistance and, again, additional federal funding for chemical dependency treatment. So moving to the next slide, we return to a view of total revenues and expenditures in the general fund. This slide gives the first look at the planning estimates for fiscal years 22 and 23. The chart shows the structural balance between revenues and expenditures in 2021 and 22-23, meaning it removes from the chart the impact of balance forwards and reserves. So all we're comparing here is the revenues coming in that biennium to the expenditures within that biennium. You can see from the chart that the structural balance declines into the planning years. Revenues only exceed expenditures in 22-23 by $456 million. I also want to highlight that this is representing the structural balance in the general fund. Not included in this total is the projected deficit in the Healthcare Access Fund. With the expiration of the provider tax, the Healthcare Access Fund is forecast to have a $969 million deficit into fiscal year 22 and 23. And additional information on the Healthcare Access Fund will be available on our website. In this forecast, the expenditures, the Healthcare Access Fund covers about 6% of medical assistance expenditures, and those expenditures remain tracked in the Healthcare Access Fund. So in coming legislative sessions, policymakers will need to determine whether to lower spending or increase revenues to address that shortfall. So moving back to a view of the overall general fund, projected spending in the general fund grows from 2020 to 2023 at 2.9%, which is greater than the 2.5% annual growth in revenue. And that is the slower growth that Dr. Kalambokidis referenced earlier. The biennial growth in expenditures is just the growth that's occurring within forecast programs. And the biggest driver of that growth is medical assistance. There's $2.8 billion projected in total growth between the biennia, and $1.8 billion of that is due to growth within medical assistance. And as a reminder, inflation is generally not included within our expenditure estimates in the forecast, except in a limited number of programs where there is an inflation component in the formula or where the formula is based on actual costs. So examples of where there is some inflationary growth is property tax refunds, special education, a portion of health care, and debt service payments. So we do provide an estimate of inflation at the bottom of the slide, but it is only applied to those expenditures where inflation is not included in the forecast. And this gives a sense of the cost pressures that exist in the upcoming biennium and into the planning years. And to highlight the fiscal year 22-23 inflationary estimate looks larger because it is based on a compounded inflationary growth from 2021.
Thank you. Since the Great Recession, the Minnesota economy has been on a steady recovery. I want to recognize and applaud the hardworking people of Minnesota for their confidence in our state. It's their financial success is an important part of the state's financial stability. And as our economy continues to grow, we must thank those Minnesotans for investing their time, talent, energy, money, and future in our state. I don't say that without acknowledging that disparities still exist. We must continue our work eliminating inequality and opening opportunities for everyone to participate in the state's growth. With this being Governor Dayton's 16th and last forecast, it's important to remember where we started and how far we've come under his administration. Making government better for Minnesotans has been our goal for the last 8 years, and from my totally unbiased perspective, we have succeeded. When Governor Mark Dayton took office, Minnesota had a state budget deficit of $6.2 billion, a debt equal to about $1,200 for each Minnesotan. To put it simply, we inherited a fiscal mess, and the lack of rainy day funds and budget gimmicks by the previous administration made matters worse. We were in a dire situation, and we had to make tough choices. During my time in business, I learned that you cannot make investments in the future without balancing the checkbook first. Under Governor Dayton's leadership, we fought back against short-sighted tax cuts that would have jeopardized our state's budget stability. Instead, we reformed our state taxes to be more fair to low and middle-income families and sufficient enough to fund historic investments in early education, K-12 education, and higher education. We also repaid the $2 billion owed to our schools and ended the budget gimmicks that did not solve our problems but just kicked the can down the road. We balanced the budget and erased our deficit, leading to surpluses in 10 out of the last budget forecast. We managed our state budget so our spending does not outpace our revenues. In 2018, a Pew Charitable Trust analysis ranked Minnesota's state budget reserves as the 10th strongest in the nation. We also managed our state's debt levels by regularly refinancing our state bonds over the last 8 years, saving over $300 million over the life of those bonds. We took advantage of low interest rates to restore our beautiful capital and make it accessible to all. We built a new Viking Stadium on time and on budget, and we're building a new medical school for the University of Minnesota, to just mention a few. I've always followed the principle to leave a place better than you found it. I'm happy to say after the last 8 years, the Dayton administration accomplished this goal by building a solid budget to support a better Minnesota for generations to come. Following 8 years of strong fiscal management, our state's economic turnaround was affirmed by national bond rating agencies. Both Fitch Ratings and Standard & Poor's gave Minnesota their highest AAA rating. Minnesota is truly a success story. We have a diverse economy that continues to grow. We have the 5th lowest unemployment among the states. Fitch says Minnesota has significant financial resilience and praised our strong control over revenues and spending and a sophisticated approach to reserve funding. S&P lauded Minnesota for our improved financial position and recently passed pension reform as an example of active management of our liabilities. I hope the new legislature and governor and lieutenant governor will maintain Governor Mark Dayton's strong commitment to fiscal responsibility that allows us to invest in the people of Minnesota. As I said earlier, I'm proud of the stable budget and well-managed finances we're handing over to the next administration. But I want to conclude by recognizing what is most important is how strong our fiscal management benefits Minnesotans and the long-term future of Minnesota. President Franklin Roosevelt, a leader who governed during precarious economic times, said, "The test of our progress is not whether we add more to the abundance of those who have much, it is whether we provide enough for those who have too little." So with that, we're happy to take questions.
Commissioner, what would this have looked like today if the legislature's spending bills earlier this year had passed?
Well, the end of
signed into law?
Right. So at the end of the session, last session, we reported a $288 million budget balance after the conclusion of that session with no tax bill or no spending bill passed. So it's a combination of a number of factors, but clearly that number would have been significantly lower, and there would have been additional spending items in the remainder of 18 and 19. So I don't have an exact number, but it would have been it would have eaten into some of the resources. Some
or a lot? Would have been a lot lower than 1.5 billion?
It would have been lower.
Commissioner, help us interpret this inflation factor that was taken out by law in 2002. Is it fair to say that we have a $1.54 billion surplus, but if we were budgeting the way we used to in 2001 and 2002, we would have to subtract $1.1 billion from that?
Well, it is true that when we pass a budget in this next year, the budget that's passed, if it doesn't include the inflationary effects, those agencies that receive budget requests will get a budget appropriation, and it will not include the increases they're going to experience over the next 2 years. So it clearly requires the management of agency budgets to try to work within the existing pressures of inflation. But I think it is true to say that without taking the inflation into account in all of our budget preparations, we are not adequately preparing the state's budget for the inflationary factors that are going to occur. Without a doubt, they're going. It's not an imaginary number. We don't know precisely what the number is, but it will occur. And one of the things I think, that we've gotten here over, 16 years. So, I mean, I think one of the things you have to look at is how do you go about changing this issue, and it'd be hard to do it all at once, but certainly it's something that we have to face.
Is this recorded?
I'm sorry.
Could you explain to us what level of uncertainty there might be depending on whether there's a tax conformity bill early in the year and what shape that might take?
Well, the tax conformity, the forecast is based on current law. So we are assuming there is no tax conformity bill at this time. So any tax conformity bill can be big or small, whatever the policymakers decide. The decision about tax conformity can be made with the idea that it conforms technically without spending a lot of money for tax relief or tax increases. The policy decision about how big or small that bill is entirely determined by the policymakers. So we don't factor in any tax conformity bill, but that's really wide open in terms of what the legislature and the governor agreed to do.
What would the impact be if federal conformity had happened on this budget?
Well, as Dr. Kalambokidis mentioned, there were some reductions in revenue streams based upon the lack of a federal tax bill, and I don't know if you have an exact number on that.
Well, the individual income tax changes that I mentioned were $70 million in the current biennium and then $250 million in the next biennium.
So $70 million in the current biennium was a reduction in revenue for individuals and $250 million in the next biennium.
Can you address more
The big picture, the arc of history here, 8 years of the Dayton administration coming in with budget shortfalls and ending with surpluses. How much did he have to do with it, or was this just history in the direction it was going to go anyway?
Well, I think I tried to mention that. I think that clearly Minnesota's economy has been recovering. And the fact of the matter is, I believe that it was Governor Mark Dayton's, what he was able to do was to take advantage of that from a stable budget perspective. And by following the increasing revenues in Minnesota in a way that made sense from a tax fairness point of view and a sufficiency point of view, we were able to benefit from the strong economy. But I think the credit for the economic turnaround obviously goes toward business people, the people of Minnesota. But clearly, I think it was important that we took advantage of that opportunity to make sure that the state's budget was consistent with the economy and growing to provide the services that people wanted.
Does this forecast take into account the $100 million that the feds said that they will not reimburse the state or are unlikely to reimburse the state for the reinsurance program? And if so, can you put the brakes on the transfer to the reserve of that $90 million?
The recent action by the federal government to reduce the amount of money for the reinsurance program of $100 million is not taken into account in the general fund. That's in the special revenue fund, and that will affect the balance going forward in that fund, but does not affect our general fund at this time.
Can you stop the transfer to backfill it?
The transfer is actually coming from the premium subsidy program, which has ended, so that it's two different programs. And there is still a balance in the reinsurance program in the special revenue fund. So they're not coming from the same pot.
Commissioner Frans, would you have a ballpark figure you give to the next administration in terms of how much they shouldn't spend, how much they should leave in the kitty?
You know, speaking as a commissioner of Minnesota Management Budget, we like to keep everything in the bank, right? So Governor Dayton has kidded me a couple times about helping him in the first 4 years to raise revenue and not allowing him to spend it in the second 4 years. I mean, clearly the goal that we will, and we've talked to the governor-elect and lieutenant governor-elect already today and briefed them on the need to maintain budget structural balance going forward, because that is the key to being able to provide the kind of ongoing investments that people can depend on. So this particular forecast provides some really challenges that we've had before. Governor Dayton's had some of these challenges where you have, large balance in one biennium and the next biennium it goes down. So that's where this whole nuance and challenge of managing one-time spending that's really one-time spending, and also trying to make sure that you have the kind of investments in ongoing projects that will fit within that budget balance. But what we've tried to advise already is to say really structural balance, maintaining structural balance in this biennium and the next is a key to making sure that you manage your spending within the money that you actually have. So that's what we've already said.
Speaker this morning said that he'd like to see the full balance rolled forward into the next cycle. Is that wise advice?
The 700 million from 19, or the?
No, I think you said about the 1.544, if I understand it correctly.
Well, I think the challenge with that obviously is that it's good to hear them recognize that we have these great resources to use. But I think the challenge with not making any investments in the next biennium is contrary to what the needs are out there. A lot of expressed needs and by different people in education and healthcare and in infrastructure, that to just avoid not making any investments for one full biennium doesn't seem very realistic to me. But
on the sales tax front, am I reading this right, that the Wayfair decision has improved the picture but not enough to put sales taxes back in the black? Is that essentially the case?
correct.
I have a couple state economist questions, if I may.
You bet.
First of all, going from Mary's question in the past, looking ahead, how much difference, how much of the impact of state economy, state changes in government have on the economy versus federal? In the past, I think you've talked about federal changes having a lot more impact than state changes. Am I right? And just looking ahead.
I'm not sure I understand. Do you mean federal policy changes?
Yeah,
or
federal policy changes or state policy changes? Taxes, spending, or whatever.
Yeah, well, in terms of the forecast, it's a current law forecast, and so we are not assuming any new state policy changes. And everything, all the state policy that has happened up to this point is baked into the cake and is part of the economy that we have now. In terms of federal tax policy, so the feds passed a tax cut that was a deficit-financed fiscal stimulus, and that did have a stimulus effect in 2018 and 2019, and that's part of the reason that the growth you see in our GDP chart for 2018 and 2019 is higher than the years that come afterward, because that stimulus fades. The federal government is able to do a short-term stimulus like that because they can run a deficit, and so they don't have to pay for that.
And the other question, give us some specific industries that are looking ahead that might face trouble or might be doing well. For instance, soybean farmers, are you counting them not doing so well, and maybe iron rings doing well, or go through some of that?
Sure. So one of the big sort of super sectors that is facing some uncertainty and some challenges right now is all the sectors that export. And so that trade policy uncertainty that I mentioned earlier, that's something that farmers are facing, it's something that manufacturers are facing. And so some people in the manufacturing area might be holding back on investments because they have to deal with supply chain disruptions now that they are facing retaliatory tariffs on their goods being exported to other countries, and they're facing U.S. tariffs on intermediate goods coming in to the United States. So that's a sector that just export in general is a sector that is facing some challenges. With regard to agricultural commodities, corn and soybeans, agricultural commodities, dairy, they have been in an environment of lower prices. The peak of prices and peak for net farm income was 2013, 2014. And so they've been coming down for 4 or 5 years of declines in net farm income. I think out of the last 5 years, 4 of them show, the USDA shows net declines in net farm income. I think it was around 2015, we started seeing on aggregate negative net farm income on Minnesota resident tax returns, so all the tax returns together. We have that continuing in the forecast until about 2020. So we think that it's going to continue to be a challenge for the agricultural sector. However, when the prices were very low and income was high, when the prices were very high and income was high, farmers, to their credit, improved their balance sheets and paid down debt and purchased equipment, and so they're in better shape financially than they were in prior farm commodity crises.
Calculate how much this picture might improve if tariffs are lifted, if that issue's resolved at some point?
So there's no way to get it all the way down to the dollars in the revenue story that I told. However, the consulting firm IHS that we use, they estimated that the full package of U.S. tariffs and retaliatory tariffs were reducing growth by what they called, it was negative but modest. And so they said 1/10 of a percentage point in real GDP growth per year through I think 2022.
I think we have time for one more question.
It was 1/10 of a percentage point, so 0.1 percentage points
I think we
per
have
year.
time for one more question.
We heard a good deal from Republican legislators about their desire to use some of this general fund surplus for transportation purposes, roads and bridges specifically. We don't know, because I don't think our documents include what's going on in the State Highway Trust Fund. What's the situation there? Is that fund heading into trouble? Is it in a deficit posture at any point in the future? And what's the trend line on gas tax revenues?
Well, the trend line for gas taxes is the state, and the fund has always been problematic in not being able to meet the need that we have going forward. So as Governor Dayton has said all along, and our administration has said, we need a dedicated source of revenue for the transportation. It would be an added gas tax or whatever. So the fund does not have enough money in it to sustain the entire growth that we need, the $6 billion over 10 years. So we need to supplement that, and that the goal would be through a dedicated tax.
What's current state gas capacity in this market?
We could Right now, we're well within our debt guidelines. We typically issue a report that will be out today that would say that we could generate up to a $3 billion bonding package and still be within our debt guidelines. We're not recommending that size, but we're just saying we're well below all of the debt guidelines at this time.
I'm seeing projected balance and projected surplus being used interchangeably. Is there anything significant about the use of those two phrases?
Yes. Surplus is what we call it's in the bank. Balance is what we project. So really, that's why we say a projected balance for 2020 and 21, is because we haven't collected that money yet. So that's a projected balance. Surplus is what we have currently in our, well, yes. To be technical.
Express any interest in remaining in your position with the next administration?
Well, that's kind of an odd question to ask me right now, I think. You know,
I asked it for that reason specifically.
one of the, let me just say this. I've indicated my interest in serving additionally. But the other good news is whatever Governor-elect Walz decides and Lieutenant Governor Flanagan, I couldn't be entering a job market at a better time, right? Because there are more jobs out there than job seekers. So I have a great opportunity ahead of me, I think. So, and I'll give you my card when I get done. Thank you.